Shares of footwear company Crocs jumped over 20% early in trading on Monday. I'm recording Monday morning, and the company announced at a conference that it expects sales for the fourth quarter to be a little bit better than expected. So today I want to go through exactly what's going on at Crocs, where there's points of strength, where there's points of weakness, and what to think about this stock, because I did a deep dive on this stock recently, and what's really attractive is that the valuation for the company is relatively low given the strength of the brand. They got very high margins. Growth has been actually really strong in a lot of parts of the world, like Asia. So there's a lot of strength that it doesn't seem like the market is giving it credit for. We also learned a little bit about what they're doing with their capital, paying down debt, buying back stock. So we're going to get into all those things today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they're going to give you their top 10 stocks to buy right now. And I'm going to just start with the day's performance. It is just before noon on Wall Street as I'm recording. The stock is up 20.6%, but it's really been a pretty volatile year. So if we go back to the one-year chart, shares are actually still down 8.1% over the past year. So pretty big low here. And this is really where I started getting interested in Crocs and actually started building a position in the company with the presentation that they gave today, January 8th, 2024. And this is the high-level look. Management said they expect revenue to be about $3.95 billion, or up 11% from a year ago. I have the third quarter presentation pulled up as well, so I'm going to go back and forth between these two a little bit to show what they said when they reported third quarter a couple of months ago. In this case, they expect $3.95 billion. Their current guidance as of the third quarter was 3.905 to 3.94, so a little bit lower than what they actually are expecting to report. They split things up here into the full year numbers and then the Q4 numbers. I'm going to focus on Q4 because that's really where the surprise came in. Crocs brand revenue expected to be up almost 10% from a year ago versus guidance of 4 to 7%, and Hey Dude brand still down 19% year over year versus guidance of a decline of 20 to 25%. So things aren't quite as bad as they were at Hey Dude. They've done some changes there with the way that they're distributing their products and who they're distributing through. So that's kind of made the numbers a little bit messy. So I wouldn't be too alarmed with the absolute number there, but definitely is a brand that isn't growing in the way that Crocs was. That's one of the reasons that the stock is the value that it is today. Operating margin expected to be in excess of 27%. So again, this is a company that's made products relatively inexpensively. I mean, when you're making just a rubber shoe, it's pretty cheap to make that product and have a pretty good price point. So that's why they've been very profitable in the shoe business for quite a long time. The thing that really stuck out to me in this presentation is what they're doing with their free cash flow. So they're generating cash from the business, and they actually had a lot of debt on the balance sheet because of the Hey Dude acquisition. So one of the things that they're doing is paying back some of that debt. They said they've repaid $1.2 billion in debt since the Hey Dude acquisition, including $665 million in 2023, and they bought back $24 million of stock. They said that $277 million of that net pay down was in Q4. So if we go over to the Q3 numbers, which would be the comparison we want to have here, long-term debt at that time was $1.9 billion. So it looks like that's going to come down pretty sharply. That's really positive for the balance sheet. Gets the company to a much more stable balance sheet position and gives them a lot more flexibility. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. We're also starting to get an idea of what 2024 is expected to look like. This is what they announced at the conference today, said that the Crocs brand is expected to continue to grow 4 to 6%. So that's a relatively slow growth rate, but stable growth for a brand that has momentum in certain parts of the world and is kind of slowing in other parts of the world. So I think that's pretty solid given the valuation for the stock, which I'll get to in a second. Hey Dude, flat to slightly up. Again, this is from a pretty down year for Hey Dude. So the goal would be that they can at least turn that positive. And then operating margins expected to improve a little bit to about 25%. So that's a really solid number for operating margins for a shoe company. Now, some of these numbers seem pretty modest for Crocs, and that's really true if you compare it to a lot of other brands in the apparel space. But what I think makes Crocs very different is the fact that this is really a cash flow business. They have such high margins that even if revenue falls slightly, this could be a really solid business that just continues to generate cash. And what investors are actually paying for today is just that cash flow business. As I'm recording, the price to earnings multiple is 8.0. On a next 12-month basis, it's 7.2. That's before any adjustments related to this better than expected quarter in the fourth quarter. The enterprise value to free cash flow is 9.1. That pulls back in debt and cash that's on the balance sheet. Expected enterprise value to free cash flow next year is just 6.6 times. So Crocs as a company could continue to pay down debt pretty rapidly, could start to buy back shares more aggressively. $25 million is a pretty modest buyback for a company that has generated $836 million in free cash flow over the trailing 12 months. So I think there's a lot to like with this report. If Crocs gets back to any sort of semblance of growth with the Hey Dude brand, which I think has been a really difficult acquisition for them, paid a lot of money for it, expected it to really bolster the company's operations, add to the scale that they have from both a manufacturing and a distribution standpoint. And I don't know that we've really seen that benefit yet, but we may be seeing it turn the corner to positive revenue growth in 2024. That's what management is expecting. If we have steady single-digit revenue growth for the main Crocs brand, and they just continue to churn out cash, that can be a very good business. You don't have to be a growth business to be a successful investment if you're paying the right price. And I think that's what is attractive for Crocs, is it is such a cheap stock that management has a lot of optionality with what to do with that cash flow. And the fact that they're paying down debt as quickly as they are right now means that the risk for the company that debt was going to have a huge overhang is really started to decline. Debt is not nearly the problem that it was. Management said that they expect leverage to be under 1.5 times. So that's a really reasonable multiple. A lot of companies are raising debt at 3 or 4 times EBITDA is what you would use as the proxy there. So over the next couple of years, it's possible that Crocs could use all of its cash flow and just pay down all of the debt that it has. I don't know that management is going to do that, but there's a lot of options when you're generating this much cash. And it doesn't seem like the Crocs brand in particular has lost the cachet that it has. I think one of the interesting comments from the last few months was the CEO saying, hey, people are not going back to buying dress shoes anymore in the same way. They want to work from home and they want to wear things like Crocs. So maybe this is a brand that has a lot more staying power than it used to. I stayed away from Crocs for a very long time, in part because I didn't think that the brand was going to be sustainable and the styles were going to be sustainable. I think that has proven to be wrong. And that's one of the reasons that I've changed my tune on Crocs over just the last 6 months or so. It isn't necessarily a brand I'm going to be spending a lot of money on, but that doesn't mean that there aren't a lot of people, both in the US and around the world. Remember, a lot of that growth is in Asia right now. And as these products get more popular around the world, there's clearly a huge market for Crocs to address. A great step in the right direction with what we heard from their presentation. It looks like guidance is going to be pretty good. I'm interested to hear more from management when we get the full fourth quarter 2023 numbers, because that's when we'll have those solid numbers, not just kind of ranges in growth rates and revenue and things like that. So that will be a few weeks down the road. But right now, Crocs looks like it's headed on the right path. What do you think about Crocs right now, especially after its 20% pop today? Love to hear your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.